Okay, good evening and welcome to today's lecture. We are continuing with our discussion on investment appraisal techniques, a very important area in financial management. It's one of the fundamental areas that we need to pay close attention to. So we have an idea of the general concept about investment appraisal, and we are expected to develop skills to solve investment appraisal questions. So this is exactly what we are going to be doing this evening. So we touch on working capital, an example that involves working capital. Working capital, as we know, is funds that goes into an investment purposely to fund our inventories, raw materials, to turn them into finished goods, to sell and make some cash flows. So let's quickly go through this example and see how investment appraisal questions involving working capital is handled. All right, so a machine costs 100,000 Ghana cedis to purchase. In addition, a further 20,000 Ghana cedi working capital will be required at the start of the project. The project is expected to last 4 years and to have a scrap value of 20,000 Ghana cedis at the end of its useful life. Net operating cash flows are expected to be 30,000 Ghana cedis per annum for the first 2 years and 40,000 Ghana cedis per annum for the following 2 years. All operating flows are to be assumed to occur at the end of year. Required. Calculate the net cash flow for each of the years in question. You are not required to discount or arrive at an investment decision. Okay, so if you look at this question critically, it is giving us an initial investment cost of 100,000, which went into the purchase of equipment. And oftentimes, if you are making investments in equipment, you would need working capital. So once you have your equipment, you need your raw materials, you need your inventories, which would be turned into finished product by this machine that has been bought. So the machine cost 100,000, and what is required to purchase our inventories, our raw materials, is 20,000. And in most cases, these two funds or cash flows occur within the same period. That is the initial period of the investment. And this project is for 4 years. It's for 4 years. So you expect that at the end of the 4 years, the equipment or the machine would be scrapped for 20,000. So there's going to be an inflow from the sale of the equipment after 4 years. Net operating cash flows are expected to be 30,000. So thus 30,000 net operating cash flows represent the inflows minus the outflows. That is the income minus expenses. So that comes to 30,000 for this question. And this is for the first 2 years. And for the third year, this net operating cash flow is going to be 40,000 per annum. All operating flows are to be assumed to occur at the end of the year. In fact, thus is the basic assumption underlying investment appraisal, that cash flows are deemed to occur at the end of the financial year. Now we are required to calculate the net cash flow for each of the years in question. Emphasis on working capital. How do we handle the working capital? All right. Now remember that working capital requirement, as we discussed in our previous lecture, is a cash outflow when it comes when you start the investment. So when you lay out your investment plan. You have your year zero, that is the initial period when the investment was made. And then you have the 4-year horizon from year 1 to year 4. Notice that machine, the 100,000 we spent in the machine occurred in year zero, as well as the working capital. And these are cash outflows all the time. Now remember that as the years go by, it may be necessary to either increase or decrease working capital requirements. So if you needed to increase working capital in, say, year 1, the cash flow, so assuming that you started with 20,000, and then in year 1, you require 25,000 Ghana cedis. Now, what would be the cash flow in year 1 would not be 25,000. It would only be what, 5,000, because you already have the 20,000. So you only need an additional or incremental working capital of 5,000. So the cash flow for year 1 would be 5,000. So this is just for us to remember. Now, in this case, there was no requirement to increase working capital throughout until the end of the project or the investment. Now, also notice that anytime we put in working capital at the end of the investment period, that working capital has to be released. And then it becomes what? A cash inflow. So cash outflow from the beginning, and then cash outflow from the beginning and cash inflow at the end of the 4 years. And remember, this occurs at the end of the period. So that's why it's in year 4. And we're also told in this question that the scrap value of this machine at the end of the 4 year is going to be 20,000. So you lay that one out. That also is a cash inflow. All right. And then we have the operating flows. The question said operating flows was going to be 30,000 for years 1 and years 2. So you have them laid out beautifully here. And then for year 3, operating flows went up to 40,000, and in year 4, also 40,000. So this is how working capital comes in when you have investment appraisal. That's the simplest working capital you'd have. There's no requirement for changing working capital throughout the period, except that working capital is released at the end of the period. So what you do next is to sum up your net cash flows, or calculate your net cash flows for each of the years. And then this is what we have. So beautifully laid out here. And if you had further information, like the discount factor, we could go on to discount these cash flows, and then we arrive at our net present value. That is our NP. So basically, this is what the question is requiring us to do. Lay out our working capital at the beginning, and then we release working capital at the end of the 4 years. So let's not forget this. All right, let's move on. Let's look at question 2. A machine costs $15,000 and is expected to last 4 years with a scrap value of $2,000 at the end of 4 years. The sales revenue and operating costs for each of the 4 years have been estimated as follows. Have been estimated as follows. Year 1, year 2, year 3, year 4. You have sales revenue and you have operating costs. So these are the cash flows for the investment. Working capital of 10% of the year's revenue is required at the start of each year. Remember, working capital of 10% of the year's revenue is required at the start of each year. Required. Calculate the net cash flow for each of the years in question. Okay. So we lay out beautifully the cost of the equipment, which is 15,000. That comes in before the beginning of the project. That is in year 0. And then let's look at working capital. Working capital also comes in year 0, which is 500. We're told that working capital is what? 10% of the year's revenue. So if you needed to make a revenue of 5,000, your working capital for that year or before that year should be 10%. So for year one, when you have started your operations, you would need working capital of what? 10% of 5,000, which is 500 Ghana cedis. 500 Ghana cedis. 10% of 5,000 is 500 Ghana cedis. And remember, working capital has to come in even before the start of year one. So that cash flow, the timing of the cash flow is in year zero. Okay. In year one, the working capital requirement would be 10% of revenue in year two. So revenue in year two is 11,000. 10% of 11,000 is 1,000. It should be 1,100. Yes, 1,100. All right. And now remember that in the previous year, it was 500. In year one, it's 1,100. So as I said before, what we record is the incremental. In year one, if you need 1,100, the incremental can only be what? 1,100 less what is already there, 500. So 1,100 less 500 gives you 600 Ghana cedis. So thus is the working capital requirement for year one. Is the differential or the incremental. Now, when we get to year two working capital is 10% of 8,000. 10% of 8,000 is 800. Now, 800 cedis is what we require in year two. But remember that we already have what? 1,100. 1,100, that's 500 plus 600, 1,100. And we need to reduce it to 800. So 1,100 less the 800. It means that in year two, we are what? Reducing working capital requirements. So that will bring us to what? 1,100 less 800, giving us what? 300. And this becomes what? Cash inflow, because you are reducing. If you are increasing, it is cash outflow. If you are reducing working capital requirement, it's cash inflow. So that is 300 Ghana cedis. When we go to year three requirement is 10% of the revenue in year four of 9,000. So 9,000, 10% of 9,000 is 900. And remember, we had 800 as at year two. Now we are going to year three, which would require us to have working capital of 900. It means we need additional what? 100. And that becomes what? Cash outflow. So that is what we have over here. Right? So you have 500, 600, 300, 100. So thus then becomes the working capital that would be released at the end of the 4 years. So it's going to be the sum of thus, that, and that, giving us what? 900. So 900 will be released at the end of the period. So you can do that calculation and see. And then the next thing is for us to just compute our net cash flow, and then we are done. So this looks quite simple, but let's pay attention to the incremental working capital requirement that we need, not the full working capital. As long as you have some working capital already in the business, if you are increasing working capital requirement, the cash flow is the difference. The cash flow is the difference. If you are reducing, it's the same way, it's the difference. and so on and so forth. And then at the end of the period, you release working capital by making sure all these put together would give you what is going to be released at the end of the 4 years. Okay. Now let's turn our attention to taxation, another complicated area when it comes to investment appraisal. And when dealing with tax, the following are assumed. Tax is calculated on operating cash flows. Tax is calculated on operating cash flows. There is no advance tax payable. There is no advance. Usually you don't pay taxes in advance. You pay them rather either in the same year as the tax liability arises or in arrears. You pay them the following year. There is no tax on working capital, either the outflow or the inflow. And there is no pool of assets for capital allowance calculations. No other taxes are relevant. All other taxes are ignored, like capital gains tax are not important here. Okay, so we take a question that involves taxation. So a company has a year end of 31st December each year. It is considering the purchase of a new machine on 1st January 2003 at a cost of 10,000 Ghana cedis. The machine is expected to generate net operating cash flows of 5,000 Ghana cedis during the first year, 7,000 Ghana cedis during the second year, and 8,000 Ghana cedis during the third year. It is intended to sell the machine at the end of the third year for 6,000 Ghana cedis. Additional working capital of 1,000 Ghana cedis would be required at the start of the project. Corporate tax is 30% payable 1 year in arrears. Capital allowances are available at 25% per annum on a reducing balance basis. The cost of capital is 10%. Calculate the NPV of the project and advise as to whether it should be accepted or rejected. Okay, so this is quite a loaded question. It's a full question. So first of all, before you lay out your investment profile, you need to do some basic calculations regarding your capital allowances. And then if there were any other, we'll do that before we lay out our investment appraisal. So let's go and look at capital allowance. We're told that capital allowances are available at 25% per annum on a reducing balance basis. So on a reducing balance basis, and this would be on the equipment, the cost of the equipment. So on a reducing balance basis, this is how the calculations is done. So you lay it out like this. You have your cost of equipment, which is 10,000, and then the capital allowance is 25% reducing balance. So 25% of 10,000 gives you 2,500. You less the 2,500 capital allowance from the cost, and that gives you 7,500. Now the tax savings you'd make on this is the corporate tax of 30% times the capital allowance of 2,500, and that gives you 750 for 31st December 2003. The following year, the balance you are bringing is 7,500. You compute 25% capital allowance on the balance of 7,500, and that gives you 1,875. So it is on this that we make tax savings 30%, and that gives us 563. And we have a balance of what? 5,625 going into the third year. Now, remember in the question, we're told that at the end of the third year, the equipment would be sold for 6,000 Ghana cedis. Now, in the third year, there are two things you do. Or at the end of the project, there are two things you do. What you do is that you check the balance that is coming into the final year. Compare it to the proceeds. Okay, compare it to the proceeds. If This is what we refer to as the tax written down value. This is the tax written down value. If the tax written down value, okay, is greater or bigger than the proceeds you would get by selling the equipment, okay, then it will result in what we call balancing allowance. If the tax written down value is less than the disposal amount, then we have a balancing charge. Now, in this case, we have the tax written down value of 5,625, which is smaller than the proceeds of what? 6,000 Ghana cedis. So the difference between that is 375. So that becomes what? A balancing charge. So you multiply your balancing charge by your corporate tax rate, and that would give you thus. Remember, 5,625 less 6,000 will give us 375, negative 375. And so when you multiply by your 30% corporate tax, it will give you 113. So this is what goes into our investment appraisal. So we have calculated these, and we need to push them into the investment outlay. So you find them here, the first one, the second one, and then the third one. Now remember, in this question, we're told that corporate tax is 30%, payable 1 year in arrears. 1 year in arrears means that the tax liability that arises, you don't pay it the same year, you pay it the next year. So any tax liability in year 1 will be pushed to year 2. The tax liability in year 2 will be pushed to year 3, and that of year 3 will be pushed to the following year. Okay, so we have it laid out here. The tax liability, or the tax savings, that we have in year 1 was 750, but tax is paid 1 year in arrears. So that goes to what? Year 2. That of year 2 was what? 563, and that would go to what? Year 3. And then that of year 3 would also push to what? Year 4, in that order. Okay. So we have laid out our tax allowances beautifully here. So these are allowances we'll get on the payment of tax, or the tax savings. And then the other factors are the cost of the investment, which comes in year 0, and then the working capital requirement of 1,000 Ghana cedis. Notice that here we're not supposed to have changes in working capital until the end of the period. Okay. And then again, there were some operating cash flows. Let's go back and look at the operating cash flows. The machine is expected to generate net operating cash flows of 5,000 during the first year. So net means revenue less your cost. So you have 5,000, 7,000 during the second year, and 8,000 during the third year. So upon these net flows, there's going to be what? Some taxes, right? Based on the corporate tax. So on the 5,000, which arises in year 1, the tax liability is going to be 30% multiplied by your operating cash flow. So 30% of 5,000 gives us 1,500. And remember, in this question, tax is paid in arrears. So even though it arises in year 1, it is paid in year 2. So that is your 1,500 here, the tax liability. And then when you go to year 2, the tax liability is on the 7,000. That is 30% of 7,000, which is 2,100. And the liability is paid in year 3. The same way, year 3, operating cash flows or net operating cash flows of 8,000, you apply your corporate tax of 30%, and that is 2,400. You push that to year 4 because tax is paid in arrears. So you lay them out beautifully. And then at the end of the project, there's going to be the proceeds coming from the sale of the equipment of 6,000. So that comes in at year 3. So basically, we've laid out all our cash flows. And then the next thing we have to do is to compute our net cash flows for each of the years. Once we are done with the net cash flows, we go and do our, what do you call it? Apply our discount factor. Discount factor is 10%, which is given in the question. The cost of capital. So this is going to be discounted at the cost of capital of 10%. 10% discount factor for 10% in year 0 is always 1. Year 1, if you use the formula, you have it all. These are your discount factors. I don't need to go through these. Then you multiply your discount factor by your net cash flows, and that gives you your present value for each of the years. So it's laid out beautifully here. And then you find your net present value by adding up all these. Now, if you did that, 4545, four five four five 1. Sorry. You should have 6695, right? You can cross check. Okay. So let's move on. All right. So this is a positive NPV. And the decision rule is that once you have a positive NPV, you carry on with the project, you accept the project. Okay. Now let's move into another area, capital rationing. So capital rationing happens when you don't have sufficient funds to carry out your investment. And so you're having to ration your capital and see the best way to use your capital in order to achieve maximum benefit. And so this is a term used to cover the situation when company has limited funds available for investment. So you may have a number of investments you want to undertake, but you have limited funds. Now, question is, which of the investments do you undertake? Which do you take? Which do you leave? There are some considerations we need to take. This can either be because there is only a limited amount available to be borrowed. Alternatively, the company decides to itself to place a limit on the amount that is prepared to borrow for the investment. And the main objective here is to decide how best to invest a limited amount of capital available when there are several investments being considered. The best solution will be the one giving the greatest total NPV, net present value. That is it. The approach to be used depends on whether or not the projects are infinitely divisible. Whether the project is divisible or is not divisible, it's a key thing you need to consider. Now, if it is possible to invest in any fraction of a project, let's say you have a project and you don't have sufficient funds, if it is possible that you break up the investment to be able to carry on with the investment according to the funds that is available, then that makes things easier. Okay, so for instance, if we have only 10% to carry out the project, if the project is say 100, is involving 100,000, and we only have 10,000, okay, that is 10% of 100,000. What it means is that if we're able to invest the 10%, the NPV from this project should be 10% of what the 100,000 would have given us. So if say the 100,000 was going to give us $2,000, right? Then if you carried out 10% of the project, then your NPV would be 10% of 2,000 Ghana cedis, right? So this is what it means. Now, that's how we approach such questions. First of all, you calculate the NPV per Ghana cedis of initial investment. That is what we refer to as profitability index. You now rank the project in terms of their profitability indices, and then invest as much as possible in the project with the highest profitability index. We'll take an example and see how this works. So this is for an infinitely divisible project. You may have another project that is non-infinitely divisible. For such projects, you cannot use the approach we used previously. Here, there is no quick method. The only approach is to look at all possible combinations of projects that are possible using the limited amount of capital available and choose the combination that gives the highest total NPV. Right. Okay. So we'll take this question. The company has the following 4 projects available: projects A, B, C, and D. These are the capital requirements for each of the projects: 500 cedis, 600 for B, 300 for C, and 400 for D. Now, these are the cash flows that arise in the various years from year 1 to year 4. These are the cash flows for each of the projects A, B, C, and D. And there's an NPV, which is calculated at 10% discount factor, giving us NPV for each of them, A, B, C, and D. 50 for A, 57 for B, 36 for C, and 50 for D. Required. What should the company's investment decision be if there is no capital rationing? If there is no capital rationing, what decision should the company undertake? If there's no capital rationing, what decision should they take? B, capital is restricted to $1,600 at time 0, and the projects are infinitely divisible. And C, capital is restricted to 1,600 at time 0, and the projects are not infinitely divisible. Let's see how to answer such a question. Obviously, A, if there's no capital rationing, then of course, there's no limit to the amount of money that is available. So the company should go for all of them because all the investments are giving us positive NPV. So they should go and undertake all of them. And they have enough money to carry that out as far as requirement A is concerned. Now, requirement B is that they are limited to only 1,600. Now, if you put all these requirements, capital requirements together, 500 plus 600, 500 plus 600 plus 300 plus 400, that comes to 1,800. 1,800, but the company only has 1,600. So question is, which one should they undertake? Okay. So this is where we calculate our profitability index or indices. So we consider each of the projects, the capital requirements, and the NPV. These are the 2 things we need, the capital requirements and the NPV. Now, this have been laid out beautifully here. And then once you are done with that, you calculate your profitability index. That is your NPV your NPV divided by the capital requirements, right? So for A, you have a capital requirement of what? 500. You have a capital requirement of 500. Let me verify that. A is 500. Okay. And then you have an NPV of 50. So NPV of 50 divided by your capital requirement of 500, that gives you 0.1. So that is 0.1. You do same for B, 57. NPV divided by a capital requirement of 600. That gives you 0.095. C, NPV is 36 divided by a capital requirement of 300, giving you 0.12. And then D, 50 divided by 400, giving you 0.125. Now, that gives us our NPV per dollar. That is our profitability index. So the next stage is for you to now rank them in order of what? PI. The highest first, followed by the next in that order. So if you look at these PIs, which one is the biggest? Obviously 0.125. So you rank that as number 1. The next biggest is this. Project C, 0.12. You rank that number 2. The next biggest is A. You rank that number 3. And then B becomes the last. So you rank them in that order. And then remember, we have only 1,600. So what it means is that we are going to take from the 1,600, invest them in this order, D, C, and A. And then whatever is left, we now prorate it for B. So for D, we invest with a full $400. With C, we push all 300. And then with D, we push what? All 500. So that would have given us 400 plus 300 plus 500. That's 1,200. 1,200. What is left is what? 1,600 less 1,200. That is 400. So it's only 400 that is left. That cannot be used to undertake project B because project B takes 600. So we have only 400. So 400 will push all into the investment, and then we proportionately invest it. And so that will be 400 divided by 600. And the resulting NPV, as we saw before, is going to be what? The same 400 over 600 multiplied by the original NPV for project B, which is 57, right? So multiply that by 57, and that gives you 38. So the NPV resulting from project B, which is the last investment, will be what? 38 and not the full 57, because we invested only a portion into project B. So by doing this, we would have exhausted the whole 1,600, and this will be the resulting NPV. For D, C, and A, we're going to have the full NPV coming in. But for B, it is only what? 2/3, which is 400 divided by 600 multiplied by your 57, giving us what? 38. So total NPV is all these put together, 174. So that is what would happen if we were to be limited to 1,600 available. Now, let's go to the third requirement. Capital is restricted to 1,600 at time 0, and projects are not infinitely divisible. Here, you cannot divide the project as we saw in the previous example. Here, you have to do combinations of NPVs that would give you the highest, right? That would give you the highest. So if you look at it, AB plus C is giving you 143 NPV in total. AB and D would give you 157. Now, remember, look at, when you are doing this, you have to be guided. Look at the NPVs. Look at the ones that are big, right? The biggest NPVs the biggest one actually is 57. That is B, followed by either A or D. Both A and D are 50, and then C is the smallest. So in any case, we're going to have to, for each good option, you must have B in it because it's giving us the highest NPV. So if you look through here, when you are doing your combinations, do a combination that always involves or includes B. So if you look throughout here, B is here, B is there, B is here, right? Now, you do the other combinations, A and D. So you include here A, you include here D, and then you include here C and D. And then once you do that, you have to calculate your total NPVs, that results. And when you finish, you look at the NPV that gives you what? The combination that gives you the biggest NPV. Combination that gives you the biggest NPV. And that is obviously 157. That is A plus B plus D. A plus B plus what? D. That gives you the highest. So this is the combination we are going to take and invest in our project. Okay. Sometimes you'll be faced with the challenge of deciding when to replace an asset. You have an asset that can last you for, let's say, 5 years, 6 years, and so on and so forth. But you need to make a decision as to when you should replace this asset. Fine, you can use this asset for the 6 years, for instance. It's possible you can use it for 6 years. But remember, once you are using the asset over the years, maintenance costs increases year on year on, okay? And then you'd need to decide whether you should continue maintaining it at a higher cost, or you should sell it along the line so that you reduce the cost of maintenance, okay? This is what this section is basically looking at. We'll take an example and then see how this is applied. A machine costs 72,000 Ghana cedis and has a maximum life of 3 years. The running costs each year are as follows. So year 1, this is the cost, maintenance or running cost. Year 2, it increases. Year 3, it increases further. Now, when you sell this equipment or machine, estimated scrap values are as follows. If you sold it in year 1, you're going to have 24,000. As the years go by, your scrap value also reduces. So now question is, when do you do your replacement? That will give you the best value for money. The best value for money. So basically the two or the main things you have to consider is the running cost and the scrap value. And then you do your appraisal and then see which one would save you more money. Okay, now let's look at it one after the other. If we decide to replace it in year 1, what would be the cost? How much would it cost us if we decided to replace in year 1? How much would it cost us if we decide to replace it in year 2 and then in year 3 and so on and so forth? Okay, so year 1, if we decided to replace this in year 1, first of all, remember the cost of the equipment or machine is 72,000, which happens at the beginning or before the start of the project in year 0, 72,000, which is a cash outflow. And then would have incurred a running cost of 7,200 in the year 1, and then would have a scrap value of sale of 24,000, which is a cash inflow. So all we have to do is to discount these and then derive our NPVs. We're given cost of capital of 15%, which is what we are going to use to discount our cash flow. So you calculate the discount factors for 15% for year 0, year 1, and then we use that to evaluate our decision. So for year 0, always discount factor is 1 multiplied by the cash flow of 72,000. This is what you have. Year 1 is your discount factor multiplied by that. You get this. And then for the scrap value of 24,000, you multiply by that. And then you get this. And you get your NPV, which is a cash, a negative NPV of 57,384. Now you calculate what we call equivalent annual cost. Equivalent annual cost, which is the discount factor, the NPV divided by the year's annuity or discount factor for that year. So that is what we have here, 57,384 as the NPV divided by the annuity for year 1, which is 0.870. And this is the result, your equivalent annual cost. So we do same for year 2. If we decided to replace the machine in year 2, would have incurred the cost of the equipment in year 2 of 72,000, would have maintained it in year 1 at 7,200, and then in year 2, maintenance at 9,600, and then we sell it off at the end of the year, we would get 16,600, and then we calculate our NPV, and this is what we have, right? We calculate our equivalent annual cost, the NPV divided by the annuity for year 2. Remember the formula for annuity? You use that to calculate your annuity, and then you would have 1.626, and you calculate your equivalent annual cost. This is what you get, 44,878. We do that for decision in year 3, same way, cost of equipment, maintenance in year 1, maintenance in year 2, maintenance in year 3, and then the scrap value of 9,600. Work out, we get our NPV, negative 87,101. Calculate our equivalent annual costs. That gives us 38,152. So this is the annuity of 15% for 3 years. So this is your equivalent annual cost. And clearly, let's see and compare. Now, this is the decision rule. Whenever you carry out your equivalent annual cost, the decision rule is that you select the option that gives you the lowest equivalent annual cost. That is the lowest cost. Let's see here. This is giving us 38,152. This is giving us 44,000. This is giving us 65,000. So obviously the lowest cost is thus 38,152 Ghana cedis. And so this is the choice, or this is what we are going to take. So the machine would have to be replaced in year 3 because it gives us the lowest cost. It gives us the lowest cost. Okay. So this is straightforward. As finance managers, we will also be faced with the situation where we want to fund our equipment, and we'll be faced or tuned between either buying the equipment or leasing the equipment. Now, if you have the right information, it should help you to decide whether to lease or to buy. So we'll take a typical example and then work it out. Okay. A company is considering whether to buy a new machine at a cost of 100,000 or alternatively to lease it for 35,000 per annum. Okay. Lease it for 35,000 per annum. Lease payments payable at the start of each year. So lease payment is paid at the start of each year. Buying it will involve borrowing money at an after-tax cost, interest cost of 7% per annum. If the machine is bought, it will be bought on the last day of current financial year The machine will be needed for 4 years, and if purchased, will have a scrap value after 4 years of 10,000 Ghana cedis. Corporate tax is 30%, payable 1 year after the end of the financial year. Capital allowances are 25%, reducing balance required. Should the machine be leased or purchased? Should the machine be leased or purchased? All right. So let's see whether we would lease this machine or not. So you set out the cash flows, determine the NPV if you are buying it, if you're taking the option to buy it, or if you're taking the option to lease it. So you set out the NPVs, the investment appraisal, and then work out, get your NPV, and then the one that gives you positive NPV or a better NPV, you select that one. Okay. A lot of calculations here. Okay. So there's capital allowance. Always, if you have capital allowance, go to your working area, calculate your capital allowances. Here we are told capital allowance is granted as what? 25%, reducing balance. We saw the workout we did previously. So the cost of the equipment is 100,000. Capital allowance, 25% of 100,000 gives you 25,000, and your tax saving will be on the 25,000, and that is your 30% corporate tax multiplied by your 25,000. That gives you 7,500. So that's the tax savings. You have a balance tax written down value of 75,000. You bring it to year 1. So 75,000, you multiply that by your capital allowance. The rate is 25%. So 25% of 75,000 gives you 18,750. You save tax on this by multiplying it by what, 30%. That gives you 5625. Then you'll be left with a balance of 75,000 less 18,750, which is 56,250. So then you bring this to the next year. So 56,250, multiply that by 25%, 56,250 by 25%, that gives you 14,062.5, approximately that. And then this, your tax savings would arise from here. So we follow the same procedure, and then we get all our. Now in the final year, like we said, we saw in the previous example, here the tax written down value is what, 31,000, and there's a scrap value of 10,000. You can see that the 31,000 is bigger than the 10,000, and so this becomes what, a balancing allowance. So 31,000, that's this. You tax save, and then you have 6,492. 6,492. So you have your 30% applied on your difference. 31,641 less 10,000 gives you 21,641. Multiply that by 30%, and that gives you your balance and allowance of 6,492. Okay. So let's go to the phase of the investment appraisal. So the decision to buy, you lay out your cash flows from year 0 to year 5. Your cost of equipment, 100,000 at the beginning. We're not told there is any working capital. And there's a scrap value at the end of the project. Equipment will be sold, the machine will be sold for 10,000 in year 4. Tax savings, which we have calculated already. It's here, laid out beautifully here. Okay. So we bring that, we lay them out beautifully. And remember, the question says, where is it? Corporate tax is 30% payable 1 year after the end of the financial year. So even though this first tax savings is happening in year 0 when we had the equipment, 7,500. It will go into the next year, that is year 1. So it comes here in that order. That of year 1 goes to year 2 goes to year 3 in that order. So the life of the project extends to the 5th year. So after doing this, you now add and get your net cash flows. Once you are done with the net cash flows, you discount at 7%, which has been given in the question. Discount factor, you calculate your discount factors, and then you multiply your discount factors by your net cash flow. That gives you your present values. And then you derive your net present value. Okay. You go to, so this is the net present value, NPV. If we decided to buy, this is what we're going to get. Negative 69,961. Now, what if we decide to lease? If we decided to lease, the lease payment was going to be what? 35,000. Alternatively, to lease it for 35,000 per annum. Here we are told lease payments are payable at the start of each year. At the start of each year. So in year 0, lease payments, 35,000 year 1, year 2, year 3. So we pay for 4 years. Now tax savings is going to be 35,000 times our corporate tax rate of 30%. So 35,000 multiplied by 30%, that gives us 10,500. And that comes in here, year 2, because tax is paid a year after. So that of year 1 happens in year 2. That of year 2 happens in year 3 in that order. So you have 4 of them, 30% of 35,000. That gives you a tax savings of about 10,500. You lay it out beautifully. And then here too, the same way, you calculate your net cash flow for each of the years. We have a discount factor, which has been given as 7%. We use that to derive or to calculate our discount factors. Then we calculate our present values for each of the years. And we look at what the net present value. Net present value here is given as 93,608. Now, between thus, negative 93,608 and negative 69,961, which one is better? Obviously, this is better. This is a smaller negative. Smaller negative. So, the lesser evil, so to speak. So this is better. So we carry on with the decision to what? To buy and not to lease, because that would give us a better net present value. Let's discuss sensitivity analysis. This is another critical area when it comes to investment appraisal. Oftentimes you have questions dropping, not always, but it's important we understand how to apply sensitivity analysis. This is a way of measuring risk. You want to look at the risk involved in your investment appraisal. So it looks at the effect of changes in the variables that goes into investment appraisal. How do changes affect the investment? So that is a measure of risk. That's a measure of risk. So to better understand it, let's take a question and then see how this is worked out. Question. Diana has just set up a new company and estimates that the cost of capital is 15%. Her first project involves investing in 150,000 Ghana cedis of equipment with a life of 15 years and a final scrap value of 15,000. The equipment will produce 15,000 units per annum, generating a contribution of 2.75 Ghana cedis each. She estimates that additional fixed cost will be 15,000 per annum required, determined on the basis of the above figures. whether the project is worthwhile. B, calculate the sensitivity to change of I, the initial investment, II, the sales volume per annum, the contribution per unit, the fixed cost per annum, the scrap value, and the cost of capital. So basically, we are being asked to determine how changes in initial investment can affect the investment. How would changes in the sales volume per annum affect the investment? How would contributions per unit affect the investment, and so on and so forth. But first of all, we are required to determine on the basis of the above figures whether the project is worthwhile. That is, where it is sensible to make this investment. Is it going to give us a positive NPV? Yes. If it is, we go ahead. If it is no, we are not going to go ahead with the investment. All right. Obviously, this is going to give us a positive investment. If you get a question like this, and then something like this follows, obviously, without going through the question, you expect that your NPV should be positive. Because if it's not positive, you will not even go ahead to be looking at these things, right? Okay. So we'll quickly go through the NPV calculations. We have a initial capital outlay of 150,000, which is happening in year 0. And year 1 to year 15. This is a 15-year investment. It's going to take 15 years. Now, the good thing is that we're told that the equipment is going to produce 15,000 units per annum. So for each year of the 15 years, we're going to produce 15,000. It makes things simple. And then a contribution of 2.75, right? She estimates that additional fixed cost will be 15,000 per annum. Okay. All right. So let's look at the contributions that is coming out of this. Contribution 15. Where is it? Contribution. Contribution of 2.75. 2.75. Okay. For how many units? So this is 2.75 each. And for the 15,000 units, we're going to have 41,250. That is 2.75 multiplied by 15,000. That gives us 41,250. So there's the total contribution each year that is coming out of the investment. And there's also a fixed cost. We are told fixed costs. She estimates that additional fixed cost will be 15,000. Now, let me explain this here. Remember, we said fixed cost in general is not relevant for investment appraisal. But if it is additional fixed cost or incremental fixed cost, you need to take that into consideration. In this case, this is additional fixed cost, so we need to take that into consideration. Of 15,000 Ghana cedis per annum. Okay, so that is that. So for each of the years, notice that year 1, 15,000, year 2, 15,000, and so on and so forth, up to year 15. The same way, the contribution, 41,250 each of the years. Now, if you wanted to do discount factors, what you would normally do is to discount each year. That will make a long work. So the shortcut is for you to calculate the annuity of 15% for 15 years. We know the formula. You use that to calculate, and you get 5.847. What it means is that all the discount factors from year 0, year 1, year 2, up to year 15, if you put them together, it will give you 5.847. There's a formula for that, which we have gone through already. So I will not belabor on that. And at the end of the project, at the end of the 15th year, we're going to scrap the equipment for 15,000. So that comes in. So this happens only in year 15. And so you calculate the discount factor of 15% for 15 years, or the 15th year. That gives you 0.123. So these are your discount factors. You multiply by your cash flows, and that gives you your present values. Once you are done, you calculate or you compute your net present value by adding up all your present values. And thus, there's a positive NPV. Obviously, we'll go ahead with the project. Now, if we go ahead with the project, what are the risks in this? So that is what the second part seeks to ask. What is the sensitivity of the initial investment? Sensitivity of the initial investment is the net present value of the investment divided by the initial investment of 150. Multiply or express that as a percentage, and that gives you 3.55. So this is the sensitivity. Sensitivity of sales volume. Sales volume, you have your NPV divided by what? Your sales volume. Sales volume is 241,189. This is it. Now remember, sales volume is within the contribution. Sales. Before you get your contribution, contribution is what? Sales less variable cost. So the sensitivity is within this contribution. So that is what? Your NPV divided by your contribution for the period, and that you express it as a percentage, that gives you negative 2.21. You do the same for contribution. Contribution is also within here. So you do the same thing, the same formula, it won't change. It's the same you're going to get. If it was variable cost is also within the contribution. You would also use the same thing. So variable cost would give you the same, negative 2.1, if the question had asked for it. Now let's look at sensitivity of fixed costs. Sensitivity of fixed costs. Sensitivity of fixed costs, your NPV divided by your fixed cost. Your fixed cost is 705, sorry. You express that as a percentage, you have 6.08. Sensitivity of scrap value. Scrap value is what? 1,845. So your NPV divided by your scrap value expressed as a percentage. So thus is, so you can see that this is quite sensitive. Negative 289, quite sensitive, right? Quite sensitive compared to the others. All right. Now there is a last one, sensitivity to change of the cost of capital. Change of cost of capital, here we use IRR. IRR, you remember the formula for IRR, or you remember how we derive IRR, internal rate of return. So anytime they ask you to determine the sensitivity of the costs of capital, you use IRR. It is not the same formula as we did for the other ones. Use IRR. And IRR, remember IRR, we need two things, two main things. You first of all have to have two discount factors. Use those two discount factors to derive your NPV. So arbitrarily discount factors. Just select any two discount factors, and then you use that to derive your NPV. So each discount factor would have its NPV. So for the two, each of them would have NPV and discount factor, and we use that to put into the formula to calculate. Now already we have a discount factor of 15%, and we know the NPV of what? 5,329. So all we have to do is to pick another discount factor, right? We pick another discount factor and use that to derive what the NPV would be, and then we'll go ahead to calculate the IRR. So here we chose 20%. Remember we said one of the key things you should be looking out for is at least one of the discount factors should give you an NPV which is 0 or negative. Now, 15% is giving us a positive NPV. If you wanted a negative NPV, you remember we talked about this. We have to raise the discount factor Once you raise it, you expect, because this is close, this is 5,000. If you raise it, it is going to push it down close to zero and even negative. So here we decided to use 20% to discount it. The same cash flows as before. The only difference is the discount factor. Remember, this is annuity for 15 years using 20% as the rate. And this is the discount factor of 20% for year 15. You use that to multiply by your cash flows as before, the same cash flows, nothing changes. The only change is the discount factors. You get your present values and then your NPVs. And you put that into your IRR formula. So you have here, that is the lower discount factor. So lower discount factor is 15%, and that's the NPV for lower discount factor. Higher discount factor, 20%, and that's the NPV for higher discount factor. So lower discount factor plus NPV of lower discount factor divided by NPV of lower discount factor minus NPV of high discount factor. This is minus negative 26, which becomes positive, right? We multiply by high minus low. That is high discount factor of 20% less low discount factor of 15%, giving you a difference of what, 5%. You compute and then you arrive at what, 15.84%. 15.84%. Okay. 15.84%. So that is your IRR. The sensitivity of cost of capital becomes your 0.84 divided by 15. So it becomes your IRR (0.84) 0.84 divided by 15, 0.56. Express that as a percentage. That's 100%. Okay. Okay. So your sensitivity for your discount factor now becomes your IRR less your 15%, your 15% being the discount factor that was used to appraise the investment in the question, which was given right here. The cost of capital, 15%. So it's going to be your IRR of 15.84 less your 15% over 15. So you are looking at what is the gap between this IRR and your cost of capital. Okay, the gap between your IRR and your cost of capital. So it's 15.84 minus 15, giving you 0.84, expressed as a percentage of the cost of capital, right? So that is 0.84 divided by 15 times 100. And that gives you 5.6%. Okay. All right, let's look at simulation. Simulation is a technique that allows more than one variable to change at the same time. So sometimes, like we saw previously, we just saw that so many things can change. The initial investments can change and it will affect the investment. Sales volume can change, contribution can change, variable cost can change, fixed cost can change, scrap value can change, right? Now, with what we have done here, we are trying to see the change of each of this, keeping all the other variables constant. But in simulation, you want to see how more than one variable or changes in more than one variable affect the investment. Obviously, this is not going to be easy. Looking at how all these, let's say, three factors are changing and how does it affect the investment. Usually, these are done with a lot of computational work. So we are not expected to know or know how to do it, but at least you should understand what simulation is. There are various stages of simulation. First of all, you identify the various or major variables. Sometimes you can have lots of variables, but you pay attention to the ones that are quite significant. And then you specify the relationship between the variables, attach probability distributions to each variable, and assign random numbers. You simulate the environment by generating random numbers, record the outcome of each simulation, and then you repeat this exercise to obtain p distribution of possible outcomes. So you have a probability distribution. So you use that, and then there are algorithms that can be used to calculate all these. Like I said, we are not required to know exactly how this is done. All we have to know is understand what stimulation is, what goes into stimulation, and then that's the end of it. Okay. When you have probability of outcomes, you have probability that, for instance, something is going to happen, and there is a probability that that thing will happen. Okay, it is possible that this will happen maybe 7 out of 10 times or 5. That is a probability. Okay, we want to see how we incorporate these probabilities into the various variables that go into investment appraisal and see how the expected outcomes are going to be. So here we identify various possible outcomes for each uncertain variable. Anytime you hear probability, it means there's uncertainty. So in terms of, say, your variable cost, you are not certain that, for instance, variable cost would be 50,000. At what level? What is the risk? What is the uncertainty? Is it 70%? Is it 10%? Is it 30%? So you use the expectation, the probability, to be able to derive what we call an expected value and use that to appraise your investment. So you identify the various possible outcomes for each uncertain variable together with the associated probability. We then use for each uncertain variable the weighted average outcome or expected outcome and use these figures in our investment appraisal calculation. Right. So let's take a question and then apply this. Okay. So D PLC is considering launching a new product. This will require additional capital investment of 200,000 Ghana cedis. The selling price of the product will be 10 Ghana cedis per unit. D has ascertained that the probability of a demand of 50,000 units per annum is 0.5, with a probability of 0.4 that will be 20% higher, and a 0.1 probability that will be 20% lower. Okay. The company expects to earn a contribution of 50% and expects fixed overheads to increase by 140,000 per year. The time horizon for appraisal is 4 years. The machine will be sold at the end of 4 years for 50,000. The cost of capital is 20% per annum. Required: calculate the expected NPV of the project, B, assuming that the demand is certain at 50,000 units per annum, what is the NPV of the project if fixed overheads are uncertain, as follows? So this is quite a loaded question. We'll take it one step at a time. So first of all, we need to calculate our expected demand. We're told that, let's go back to the question. The selling price of the product will be 10 cedis per unit. Each unit is 10 cedis. D has ascertained that the probability of a demand of 50,000 units per annum is 0.5. With a probability of 0.4, that it will be 20% higher, and a 0.1 probability that it will be 20% lower. Now remember that probabilities would add up to 1, okay? So the totals, the probability is 0.45, is 0.4, making 0.9, and then 0.1, totaling 1. Okay, now for a demand of 50,000 units per annum, the probability is 0.5. With a probability of 0.4, that will be 20% higher. 20% higher, that is 60, right? 20% times 50,000, that is 10,000. So 20% higher. So 10,000 plus 50,000, that gives you what? 60%, sorry, 60,000. So at a probability of 0.4, we are having what? 60,000 units per annum. And a 0.1 probability that it will be 20% lower. 20% lower, 0.2 times 50,000 units, that is 10,000. So 20% lower, that is 50,000 less 10,000, that is what? 40,000 units. So that's what we're going to use to calculate our expected values. So for the 50,000, the probability is 0.5. For the 60,000, probability is what? 0.4. And for the 40,000, the probability is 0.1. So we use that to calculate our expected demand. So thus is the expected demand. Thus is the expected demand based on the probabilities. Let's look at the contribution. Question says, D is considering launching a new product. This will require additional capital investment of 200,000. Selling price of the product would be 10 cedis per unit. This is selling price. 10 cedis per unit. Okay. A company expects to earn a contribution of 50% and expects fixed overheads to increase by 140,000 per year. Contribution of 50% means that if you made a sales of 100, your contribution is 50%. That is 50, right? So it means your variable cost is going to be half of your sales. Let me take that again. A company expects to earn a contribution of 50% on sales. Remember, contribution is sales less variable cost. So if you're earning a contribution of 50% on your sales, then your variable cost is 50%. So your sales of 100% less your variable cost of 50% will give you what? 50% contribution. Okay, I hope that is clear now. So we can use that to calculate our contribution or expected contribution, which is our sales price of 10 Ghana cedis per unit. So 10 cedis times the volume or the demand, all right, which we have calculated already. The expected demand of 53,000 times of 50%, right? 50%. So this is our contribution. The whole of the 10 cedis is, or $10 is your what? Your sales. The contribution in it is 50%. So 50% of that, that is, so that will give you 5 cedis or $5, okay? per unit, and you multiply by the number of units, which we have calculated here, the expected number of units or demand. So that gives us expected contribution of 265,000 when we do the computation per annum. So we can use this to help us do our investment appraisal. The initial investment of 200,000, this is there in the question. And then you have your expected contribution of 265,000, which is luckily is the same for years 1, 2, 3, and 4. So remember, we have to calculate our annuity instead of calculating discount factors for each of the years. 140,000 cedis as fixed overheads. The company expects to earn a contribution of 50% and expect fixed overheads to increase, always fixed, increase by 140,000 per year. So that is a relevant cash flow because this is incremental fixed cost. So every year there's incremental fixed cost of 140,000. And the machine will be sold at the end of 4 years for 50,000. So at the end of the 4th year, we have a 50,000 scrap value coming in. It's a discount factor of that. And so we can calculate our expected NPV. So this is how NPV is calculated when you have expected values, right? Okay. So that is A, calculate the expected NPV of the project. B says, assuming that the demand is certain at 50,000 units per annum, what is the NPV of the project if fixed overheads are uncertain as follows? So in this case, we are told we are very certain about the demand of 50,000. No probabilities here. How will it turn out? So we go through the same thing as here. The only different thing is that the 50,000 is what we expect to have for instead of 53,000, right? This is expected demand. So instead of going through all these, we're going to simply have our 50,000 units multiplied by our 50%, right? We've gone through this already, multiplied by our $10 unit contribution. So that would give us 250. You can do the calculation. So 50,000 units multiplied by 50% multiplied by your 10. That would give you 250,000 for each of years 1 to 4. Okay, so we put that into our investment appraisal. We do discount factors. It's going to be the same thing. Discount factor is not going to change. And so we use that to appraise our investments. Okay. But then there is another twist here. Here we are told that assuming that the demand is certain at 50,000 units, what is the NPV of the project if fixed overheads are uncertain? Thus, fixed overheads are uncertain. So if they are uncertain, what are the probabilities of the uncertainty? Fixed overheads could be 100,000, but the probability is 20% or 0.2. It could be 140,000, but probability is 35%, and so on and so forth. So we use this to calculate the expected fixed overheads, just as we did for the expected demand. We use the same formula. Your 100,000, the probability is 0.2 or 20%. Your 140,000 probability is 35%, and so on and so forth. So you carry out that, and you get your expected fixed overheads. So you replace thus overheads that we are very sure in the first case to be 140 by our expected fixed overheads of 158,000. Go through the same thing, and then we have our NPV of what? 62,000. So thus is what we expect to be the NPV. So that's how expected values are incorporated into investment appraisal questions. Straightforward, right? Okay. So that brings us to the end of this lecture. Thank you so much for your attention. See you in the next lecture. Bye-bye.